So, gentlemen, consumer or business lending, which has seen a greater innovation in credit underwriting? And of course, the big debate that's lurking around here at the bottom of this is where is the innovation in credit underwriting going on? Now, I'd be a very rich man if I would heard every time that I hear somebody say, we've got these amazing new algorithms because we've got masses of big data coming in. Yeah. So, hang on, actually, I'll go one step back. So there's the old-fashioned banking model, yeah? Lots of, sadly, men sitting in big ivory towers, crunching through credit data, going back decades, yeah? Traditional banking model, upgraded a little bit, obviously add on, the Equifax Experian, kind of pool data stuff. But yeah, that's the way that credit's been traditionally analysed. And that's, and that's sort of credit analysis version 1.0. And then we go forward, and I said, I get £1 for every person who's come up to one of our events and said, big data, yeah, all this marketplace lending, all of these new fintech revolutions. What they've done is they've given you a lot more data and a lot more ability and transparency and statistics and numbers. You can crunch through stuff and you can have better models. And that's really going to be important, make a big difference in SME lending, for instance. SME lending traditionally has always been, I think it's a little bit more opaque than consumer lending. Consumer lending, I don't know, we'll have this debate now. Consumer lending, I think a lot of people regard consumer lending as slightly more transparent. You can see through to stuff, more accepted standards. You may disagree with me. SME lending was a little bit more difficult to get a grasp of. But with big data comes along and everything will be transformed. And suddenly it'll all be transparent. And will it be more transparent in one area, in SME lending, or will it become more transparent in consumer lending? Where are the biggest advances coming in this whole area of credit analysis? Yeah, we've already got some votes coming in. It's moving up and around, all three of them.
Yes.
So, yes, before you've even made an argument. So, who wants to kick off?
The way this is going.
I haven't even said anything.
Okay. Sorry. It's all right. Let's kick off. Go for it.
Should we introduce ourselves first?
Introduce yourselves first.
Sure. So I'm Michael Elalouf. I'm CFO at iwoca. So as you have guessed, iwoca is an SME lender. So we are a balance sheet alternative lender. We provide working capital to small businesses, primarily in the UK. So our product is fully flexible. We don't charge any fees. We go up to 100K in the UK, typically up to 12 months. I'm giving these details so that we could bring more to the conversation. And so we based in the UK and operate also in continental Europe.
I'm Brian Norton. I'm the co-founder of Future Finance. Future Finance is Europe's first large-scale private student loan company. So we're a consumer lender. And we make loans to students who are either postgraduate or undergraduate, mostly in the UK, but now also in Germany. And we help them cover the costs of their education when the government and parents and part-time work and scholarships and other things are not enough. We can help. So our typical loan size is about £7,500. Typical rates are about 9.5%, and our typical customer, relevant to this conversation, is a university student, so from a traditional credit underwriting standpoint, quite thin file, because they're young and haven't necessarily had a lot of work experience or experience in borrowing and repaying debt, so a challenge from an underwriting standpoint. So that's what Future Finance does. Yeah. So then what?
Okay. Just even in your descriptions, you've already been scoring points already. So go ahead. So where do you think where's the biggest advance going to be? Is it going to be in the thin files that you find in student lending, or is it going to be in the slightly thicker files that you find in SME lending? Where are the advances going to be greatest?
Yeah, so going back to your first point about transparency, I wouldn't phrase it in the way that one is more or less transparent than the other. I think one is more complex than the other. So if you take SME lending to small businesses, again, it's a bit technical, but our product is unsecured, where we take personal guarantees, usually on the directors of the business, which means that we have to look both at the personal credit of one or two directors of the business, as well as the credit profile of the SME itself. So if we were to only look at the director's profile, we only lend up to 10, 15K at most, like a credit card, basically, personal credit card. So we have to go beyond that and understand the business as well to be able to go to what we do, which is up to 100K.
So where are the advances being made in business then? In business, I mean, are you looking? We hear talk about, for instance, a lot of companies now use things like Sage and Xero to do all their online accounting. That gives you an awful lot more data, doesn't it? I'm guessing.
I'm glad you're quoting Xero, because we announced last week a partnership with with them. So yeah, it's very topical. So access to data is indeed critical, and the more data we get, and more live data we get, the better we'll be at underwriting and more precise, and usually underwrite more because we'd know better about the customers.
So that's very interesting. So there were some similarities here, I know, with students, but so one of the key things here is that you just get more data because there's more transparency from the companies concerned, because they're putting their accounts online, so to speak, or they're digitizing their finances, so to speak.
Yeah.
Is that helping you? How's that helping you?
So basically, if you take accounting software data, you have access to bank statements. Well, actually, live bank feeds, so it's almost instant knowledge about all the transactions that have gone through the business, which is kind of the raw data that you'd use to build your accounts. And then you have access to management accounts, tax filings, etc., on an ongoing and live basis. So with that data, you should have the best view possible on the business. Doesn't mean that you will take the right credit decision, but at least you are as informed as possible on the strength of the business.
I want just to pick up on that point, and we'll come to you, Brian, don't worry.
I'm doing great.
Stop talking.
The
more I talk, the more I'm losing.
You don't have to say anything, and it's so.
My point.
It doesn't make you a better decision. It doesn't give you better decisions. It just gives you more data. So, what kind of credit analysis could give you better decisions? So, because you could get all the data in the world you want if you still make bad decisions, which is what you accept. You accept that. So, what does it gives you? What does it allows you to make better decisions?
I think it's.
Are you finding patterns?
Yeah. So basically, gathering the data is now becoming easy. What's trickier is to make sense of that data and to understand what's relevant. And so how you do that is basically, again, throwing a big word, machine learning. So you train your engine so that it picks up what happened in the past. And so if you have a default and you can identify the reason and the outlier in terms of the credit profile of that company, and you can tell, okay, this company defaulted because of that, and so I won't do the same mistake again. That's basically building a scorecard. And if you can do that repeatedly and with a short cycle, which is our case because we have a shortened product, so the learning curve is very steep. So if you can do that repeatedly and make sure that you capture all these signs and data, then you can refine your engine and you can start doing, industry-specific underwriting, because we are industry agnostic. We lend to any small business, so you can do industry-specific underwriting and be more predictive in the loss rates you're gonna incur.
That's very interesting. So that's that kind of machine learning. I read an article a while ago about a big Chinese organisation, which they don't even have the credit files that we have in the West, and they were working with the Chinese Postal Service, and they were looking at deep machine learning from all. They run a kind of point-of-sale service in local post offices all over China, and they were offering credit out to their customers, and they were even going into things like so they weren't just looking at the point-of-sales data that they were getting in. They were looking at things like mobile phones. They were looking at other factors, and I know it's going to come back to you, Brian, in a minute, but they were looking at a wider range of data to be able to give them patterns. And they started noticing that people who, I can't remember the exact details, that people who tended to bunch all their payments at the end of the month and didn't use a mobile phone, I'm being slightly spurious here, actually, though none of us would think those two factors are related, they were related because of the machine learning actually found a pattern. Are you finding those kind of patterns that go above and beyond what we already expect? And what I mean by already expect is, hey, in the construction industry, they run out of cash sometimes. Yeah, we're not. That's not. I mean, that none of us. We all know that one.
Yeah, that's a very, very good question. I think it depends. So in certain industry, it is very relevant. So if you take online traders, so eBay or Amazon traders, you can get access to their customer reviews, and that's kind of quantifiable. It's valuable, and you can see that if the owner has been away for 2 months, on the beach, and people are complaining about the level of service, then there's a problem with the business. And
oh, really? You could get to that level.
You could see a deterioration in the customer reviews, and because it's live data feed from eBay, for instance, you can quantify that and integrate that. Other people have looked into behavioral underwriting, looking at how many likes you have on Facebook, etc. We haven't seen at this level some relevance for our business, but for certain. So I think the answer is that for certain industry-specific data type, typically online lenders, this is very relevant.
And just to be very precise here, is that data you get even above and beyond the normal kind of financial set of data, so for instance, customer review data, that is actually valuable and has been valuable for you in deciding whether or not a loan is risky or not?
Yes, in certain instances.
In certain sectors, I understand the caveat. Now, that's very interesting. So that's a lot more granular data than for instance, traditional SME lenders have. So, Brian, it's a tough time. So you can see, people like iwoca are starting off with, traditionally, and again, thin files in some respects, actually. They're relatively thin files compared to some industry, some lending sectors. And you've started making those files thicker. So, so why are you getting any better kind of credit scoring, credit analysis than these guys are?
Sure. So I think you make the point well here. I think the main thing we think when I think about underwriting is it's got to be relevant to the particular niche that's trying to be served.
Completely.
You too often I see people painting broad or throwing around big data and machine learning as if you've got junk data coming in that's not relevant, you can put all the machine learning on it you want. You're not going to make any better decisions on the lending side, and some of the consumer lenders and business lenders who I've seen come up and do actually quite well, the underwriting is, they won't necessarily say this, is quite simple, actually, at the end of the day. I mean, you don't need to have a radically complicated data science team of 60 people to be a good lender. It can help in a lot of cases, but it's not necessarily always the case. I can speak to, I have two thoughts here. At Future Finance, what we did, we're lending to students who are early in their life, and certainly at the very beginning of what hopefully will be a fruitful professional career. The data source that we pulled in that actually has been most relevant to us and is also very bespoke to our customer segment is we gathered a bunch of public and proprietary data related to outcomes. So if you're studying in the UK, you tell us which university you're attending and which course you're studying, and we'll be able to predict what you're going to earn post-graduation. We'll predict if you're going to graduate. Dropout rates in certain courses vary quite a bit, and dropouts for student lending are the biggest risk. If your customer drops out, you haven't made a student loan, you just made a loan to a young person who didn't finish university at probably a big loan at too low of a rate to a young person. So that's what you worry about dropouts. And then if they're going to get a job once they graduate, and then if they're going to get a job, what they're going to earn. And then we use that data to basically perform a debt-to-income test on the student at the time of borrowing, and not just what they've borrowed, but what we think they're going to accumulate. If they're 3 months from graduation or 3 years from graduation, you've got to take that into account. We call it the projected future affordability ratio. So we did something, I think it's a little different. Rather than sort of pulling in data and just we actually invented a ratio, a calculation that is part of our underwriting. It's proven, as we've been able now with people graduating and getting on and whatever, it is actually statistically significant in terms of prediction of defaults. So it's actually working out as a useful metric. It sounds nifty, but it also actually matters, which is good.
So I mean, a risk of always simplifying in a horrible journalistic way. If you went along to, you could probably sit down and go, somebody goes to London Business School.
Yes.
Yeah?
Yeah, we're partnered with those guys. They're probably the highest income expectations of any course. An MBA from LBS, the highest income expectation in the country.
So you could literally, with some degree of certainty, say that if you go on the course at LBS and you complete the course, correct me if I'm wrong, complete the course, and you stand a disproportionately higher chance of earning a lot more and thus repaying your debts.
That's right.
Yeah, which common sense makes sense.
Therefore, so now we make a lot of loans to people studying MBAs from London Business School, and we make a lot of loans to people studying social work and nursing from middling universities in up and down the country. We just make bigger loans to the LBS guy because we think he can handle it.
Yes. Yes. So it's not that you don't make the loans.
No, we make loans to everybody. We actually in some ways get much more fired up about a 2,000-pound loan to a nurse because it really matters to him versus So there's a social mission to what we do as well. But the underwriting algorithm we developed lets us be sort of feel comfortable about whatever the loan is. Just scale the loan to the capacity of the individual.
That's very interesting. So if I can characterize the difference, is that though there are certain industry sectors that have strong predictive characteristics, a lot of what you do is still business-centric. Yeah.
You get the personal guarantees.
And personal guarantees.
Absolutely, yeah.
So
a lot of it is still quite business-centric. Whereas actually, from what I'm hearing from you, Brian, there's a quite strong predictive element that it's not necessarily the person-centric, but it's actually the institution-centric.
Yeah, well, it's the choice the person made and their ability to get accepted on the course or whatever. And there's fun stuff in the data too. Like a nursing student from London South Bank has a higher income expectation than the average graduate from Cambridge at an undergraduate level.
Really?
Yeah, there's all these cool little things that happen because of specialties and vocational nature, and they're more mature students and nursing is in high demand. So it's like you got to use the data. If you just use your heuristic, you probably make some bad decisions and miss out on some good opportunities.
But I suppose, I mean, can I just dwell on one particular fact here? If I had in two examples, I have, say, I'm being unfair picking on nursing, but a nursing graduate.
I studied history. Do history students.
So a nursing graduate, and there's somebody who's very motivated, a nursing graduate, and somebody who's not very motivated, a nursing graduate. And then you have somebody in LBS who's not very motivated and somebody who's very motivated. So is it statistically more likely that you are basically going to make more money out of the LBS person than it is out of the one who's motivated than the nursing graduate one?
To make more money.
Are you going to make more money out of a motivated LBS student than you are out of a motivated nursing student?
The pricing is better for postgraduates. We try to sort of level price, and this ratio I'm talking about really determines the amount of the loan. So we'll make a larger loan on average, typically to an MBA, be it from LBS or Cranfield or Cass or whatever. So we'll probably make more absolute pounds from
because
those,
it's just a bigger.
But the return, and especially in the case of underwriting, like the losses ought to be roughly equivalent because we sort of scaled the opportunity to the individual. Yeah. But I think the main thing for us thinking about like sort of creativity and underwriting, as per the comment here, is what we've had to do, and what I think a lot of consumer lenders are trying to do is they're trying to sort of peer into the future of a person, whereas traditional underwriting. Bank underwriting is very backwards looking, which is a common thing for people to say, but finding ways to actually do that is sort of tricky. There's one other interesting story. I do some advisory work with a guy who's starting a microfinance business in Kenya. People in Kenya, super interesting. Their initial starting loan balance is €2. Right, it's microfinance. So some of the data that they use is they get the mobile phone data, mostly Android, mostly Android in Kenya. And one of the things that stuck in my mind is they look and see if the phone is charged every night.
Yes. Yeah.
As an indicator for
makes sense.
Wealth.
Well, also just an indication of kind of thoroughness and order
and like a regular life
absolutely,
and whatever.
Because they have to use their mobile phone to do business on a regular basis.
Yeah. So on one hand, I tend to be cynical and say, all this data and the social graph stuff, it doesn't that. It's like nonsense. It's just fun for conference talking, and it's not actually knowing it. But then you hear these things where like these little bits of things you would never think of are actually statistically significant as it comes to repayment in certain situations. Super interesting.
Can I ask why, if the predictive patterns for instance, picking somebody from LBS are so strong, just use an example, why doesn't loads of other people do it like the banks? Because the banks surely would be, if it's so predictive and so associative, the banks could just walk in and go, oh, we can add all our other stuff and we could do this. I
don't know. I'm fond of saying I've been in entrepreneurial finance my whole life. If the banks were doing all the shit that they were supposed to do logically, I wouldn't have had a career. So I don't know. I mean, if there are any bankers here, no offense, but like I think that just getting a traditional-minded credit committee over the hump of saying, look, it's predictive.
Yeah.
To say, yeah, but it hasn't happened, versus they have actually made payments on their mortgage for the last 20 years. They have been a current account holder at my bank with X balance for this many years. They have had a job for this many, like just traditional people who have been doing credit underwriting their whole life, and the people running credit committees at banks are people who have been doing credit underwriting their whole life. Like that, it has actually happened is a much easier thing to hang your hat on than something that's predictive, even if it's really, really, really predictive. Just because, I don't know, I don't know.
Very interesting. It's going back to what Rupert was saying about, because VAR models, traditional variance of risk models, are always backward-looking. And there's the danger of backward-looking risk models. Do you find that a lot of SME lenders are caught up on backward-looking risk models? Because you obviously do have a quite strong predictive element, but you must have some backward-looking evidence as well.
I mean, to take a trivial example, you would not underwrite a business that has been losing money sustainably, for long term. So that's a good indication that whether if you take a very small business, usually the business model is very simple. and it's well managed or not. And so that's kind of looking at history is a good indicator for that matter.
Is there data? Is there for the personal guarantee? You look like assets, or is it just personal credit history?
We look at personal credit history. We look potentially also at assets. And
is there an automated way to get asset data? Or do you have to collect paperwork and stuff?
We don't do paperwork. We would get some info on the data. You can collect some data.
No, actually, on your side, Brian, is there, because if you look at students are not necessarily a completely independent entity. They're quite often involved with their parents.
Yeah.
So that prompted that question. You look at associated data. Yeah. Do you ever look at parental data?
Yeah. About 2/3 of our loans are guaranteed by a parent.
Okay, fine.
But we're not looking for asset information where it's more just a credit history and some verification of income, which can be done relatively.
Okay, so that's quite a simple look at the parents.
Yes, it's a simple look at the parents without the predictive nature is on the students themselves.
Very interesting.
Yeah.
Okay, and so what's in each of your cases, what do you think is, if you had to point to one factor in your models that you think is genuinely unique, is a genuine USP, I think I probably know what yours is a genuinely USP for what you do, that really you think that none of your competitors have really got the same edge on you. What do you think that is? Michael?
I would say that we have a very flexible approach when it comes to underwriting. So we don't have any hard blocks in our process. We have factors that would make you above or under the credit decision. But if you go to banks, what they've been doing with SMEs, because it costs them so much money to underwrite a loan, they would take hard blocks like, if you haven't been trading for 3 years, I won't lend you money. If you don't have 2 directors in your business, I won't lend you money, etc. So we've taken all of that away, and we're able to be flexible. So there's not a point in our underwriting process where it would be a hard block. There would be indicators, and you go up and down depending on all the factors you look at. But we kept that flexibility, which makes it kind of harder to develop and implement and make it robust. But that's what we've been trying to achieve.
Right. Is there one thing you'd point to, the absolute USP that you can have over any of your? You haven't got a lot of competitors, I imagine. So it's not too difficult to say.
We're still the only ones doing this.
I was about to say,
here in Europe.
Yeah.
But I would tell you, in the States, I did student lending in the States, and in the States, as you might know, it's about $1.2 trillion asset class. It's bigger than auto. And about 200 billion of that is private loans, the sort of loans that Future Finance makes. I think the forward-looking predictive system that we developed that I mentioned earlier is something that I think is quite unique, difficult to replicate. We just signed our first partnership, or we're about to sign our first partnership with a bank in the UK the bank is going to market our loans, white labeled as the bank's loans, and we're going to be the lender. Right. So to your point about why aren't banks doing this, because the actually underwriting these customers, they're interested in the product. They think it's something their customers might want, but they don't yet have the interest or the energy to build the thing themselves. They're going to use us to do it. If the problem in the U.S. is a substantial over-indebtedness problem with student lending there is actually not a great story right now. And if lenders in that country had been more thoughtful about, so an economics student from Princeton and a basket weaving student from Nowheresville State University will get the same loan in the same terms in America today. And as a result, you have these people who have $80,000 of debt when they graduate, and they declare bankruptcy at age 23, which is a real shame, and it taints the whole industry and puts a lot of people in a lot of bad problems. So I think back to my first point, when you're doing credit underwriting, you got to think about the customer, whether it's small business or consumer or whatever, and try to figure out ways. Putting a customer in a bad position is bad for him or her. It's bad for the business. It's bad for the ecosystem. And so I think people would be a little more thoughtful in general, and we could all be in a much better place.
Just one final question, I suppose I'm trying to get at, the degree and the intensive nature of the credit analysis. When you get a credit file, when you get an application in either of your cases, how long does it take you, on average, which is a horrible thing to ask, how long does it take you to be able to basically go through all that with all your machine learning, all your things you look at, make a decision and get back to them?
So we do have automated lending, so the answer for that would be, I think it's 25 seconds.
All right.
It's under 30, so I'm being conservative in saying 25 seconds. But that would be for a certain type of loans.
Yeah.
And if there's manual input required, the time spent is up to half an hour at most for bigger loans. And depending on the backlog, basically, what we can offer to our customers is 24-hour funding. So same-day funding.
Brian?
Most of our underwriting decisions are instant. So like 80% they get an immediate offer from us. Then the 20% that aren't, it's because we couldn't. Students, you can't get their credit file because the address doesn't match because they gave their dormitory address, not their home address. So it's like if you can't get the data, if we get the data, it's instant. But in cases where a guarantor is required, we then say the offer is you're approved, but you got to call your mom or dad, get him or her to fill us, so they sort of get underwritten again, so that the entirety of the lending process. And then also we verify enrollment with universities. At this point, manually, there's no automated way to do that.
Yeah.
So on average, from application to funded for us is about a week, a little more than a week. Though the offer is immediate for them to kind of get all their stuff together.
Yeah. Kind of verification process as opposed to decision process.
Yeah, that's right. That's right. And by the way, we wish that was a lot shorter. It's just being the first guy. In the US, in student lending, there's a database you can hit to see, is this person enrolled in this university, studying this course? When does he graduate? Has he paid his tuition? And it's like you can ping the database, but here that doesn't. We actually physically phone universities in some cases to get the data, so it takes a little longer.
And one very last question, just give some sense about what you started off with. What proportion of the people that you accept in either of your sectors start off with effectively either a very thin or virtually no credit file, and you've effectively got to use the power of your analysis to make a decision?
It's most of ours.
Yeah, I was going to wonder. Absolutely.
I mean, you get some postgrads who are more mature and things like that. You know,
and they've probably been in work and they've
in work and pay. And actually, virtually everybody has a credit file in this kind, because being on the electoral rolls. But a lot of the students aren't on the electoral rolls.
I was about to say, not even on the electoral register.
Because there hasn't been an election since they've come of age. And with Equifax, that's worth like 100 points just being on the electoral roll. So it's no fault of theirs, not because they're bad citizens. There hasn't been an election.
So you really do start with a lot of very thin files.
Yeah.
Michael?
Yeah, I mean, because we lend to any business, we have people, running businesses in the 40s, 30s, 50s, 60s. So for them, obviously, we have more data. The question is it high or low score? And to that point, again, we don't have a hard kind of bottom floor where we.
You must have got a lot of businesses that don't really have any real credit file because they've never really bothered to borrow.
Yeah, but you look at the personal credit also.
Yeah,
so,
okay, you get it on the personal credit.
And then you get the bank data.
Yeah, okay, that's where you get it.
So if they've been trading, you can see that.
Okay, right, very interesting. And so what's the result?
God.
Consumer lending.
There are investors in the room, I know, come on.
Brian, I think you've managed to convince everybody. Look, put your hands together for these guys. I think that's a really interesting panel. And thank you very much. Very, very grateful.